So we are going to have a few conversations. The first conversation is going to be with Mike Fraser, the CEO of Goldfields. We then, please use the Slido QR code. Point your camera, it will give you a Q&A section, type your question, and I will be facilitating the conversation with your input with Mike. We then, after that, is going to have a conversation with Neil, and although he's on the program as the chairman of World Gold Council, which he also is, it's going to be a fantastic opportunity to talk to a man who's finally at the end of a flippin' long career. I mean, he's my age and he refuses to retire. So, in the good old days, we would have taken him outside and shoot him or something. But now, people just stick around. So we're going to have a conversation with Neil about his whole career, and obviously Sibanye as the culmination of that career. And then we're going to have the new, I nearly said the new chick, but that would be inappropriate, the new kid. Valterra is going to tell us what is new other than the name. So 3 fantastic conversations in this session, 3 significant African miners sharing their African story and beyond Africa. So just getting everybody to settle down. I will come and join Mike here. And Mike, I mean, I met you when you were a manganese miner. I mean, that's a long way from gold. And even before that, there must have been a story. So why don't you start, how the hell did you get into mining, or why the hell did you get into mining? Perhaps is the right question.
Yeah, no, thanks, Bernard. And firstly, thanks for inviting me here. I mean, it's really great to see so many of our countrymen and others in London. Look, I think my story is I didn't start mining in my first career. So I spent the first kind of 8 years of my life in manufacturing, which was a hell of a lot harder than mining. I thought mining was difficult, but geez, manufacturing is hard. When you're competing with the Japanese on trying to make tires at a profit, it's very hard. But then I had the benefit of joining Billiton at a very exciting time of their pathway. Recently listed in London, joined a pretty dynamic group of really world-class mining leaders who were trying to shake up the world. And very soon after that, we did that reverse takeover of BHP, which was also a massively exciting time of our career, where we actually were able to create, at that point, the world's largest diversified miner, which is still there now. And if I think about over 25 years of how this mining industry has transformed, it has probably been the most exciting journey that I could ever have imagined in the sector. And if I go back to kind of the mid-late 90s, the biggest mining company in the world at the time was Alcoa. Probably had a market capitalization of around 25 billion or so US dollars. And if you look at the top 5 mining companies now, they probably are 5 times the size of what that was, or 10 times the size of what that whole market cap was 25 years ago. And it's been a massively exciting journey for me to be in multiple commodities, worked across a number of different jurisdictions with some super inspiring leaders. And the thing that ultimately keeps me engaged in this industry is just the impact, the positive impact that we have on the lives of people. And if mining is done well, we have the ability to transform whole societies, and I truly do believe that. And that's what keeps me fully engaged and motivated in this industry.
So you must have young adult kids?
Yep, I do.
And would they agree with the sentiment that mining is good for society?
Well, I'll tell you.
Ask them.
Well, I'll tell you a funny story. The one thing about our lives in this industry is we spend a massive amount of time away from home. And when my daughter was young and she was learning about migrant labor in the workplace, she said to her teacher, "Well, my dad's one of those." But if I think about young adults these days, is that they do have a kind of jaundiced view on the environmental impact that we have. But when you can sit down and have a conversation about what the social impact is, and if mining is done responsibly, that we can actually do it and provide these materials to the world in a way that no one else can do it. But there is a strong divide, and I've seen this in having spent a bit of an excursion with a junior miner, that the juniors have a very wide range of how they're executing responsible mining compared to the large producers. And it's a conversation we have within the ICMM. You know, there's a real risk of us navel-gazing and criticizing ourselves so much, but then you have a huge part of the mining industry which is unregulated and dealing with things irresponsibly. So, but I do think there's more work we can do to get others over the line. But luckily, with my kids being closer to the industry, you can have a sensible conversation. But there's many others you can't convince. There's no doubt about it.
As coincidence would have it, Tracy and my 19-year-old son, second year mechanical engineering, obviously following in Fruneman's footsteps, is today having his first visit down at Sasol underground. So, I mean, I can't wait to hear the stories. I can't wait to hear what he makes of a mine. It will be so interesting. I don't know where you were in 2007, 2008. Were you there when BHP Billiton disposed of their beneficiation business in Nelspruit to me and my colleagues?
I was around, but I was probably in Melbourne more than I was involved in the coal business at the time with Dave Murray, you probably remember.
The reason I link that is we're going to have many conversations about but BHP Billiton, but you all should be in beneficiation. I mean, that business exists, dare I say, because BHP Billiton sold it, the option was to close it. So how far do you think should you miners go into beneficiation? Now, you in gold mining, it's a simple answer, but just put yourself back into your BHP Billiton days.
Look, I take it through an economics lens, and what's fundamentally fascinating for me is that the rent still sits upstream. It still sits with the resource. So if you can find high quality resource and extract it at a good margin, there's a high proportion of high quality return that you can get than investing in beneficiation. And in fact, that rent has not dissipated. And if anything, you've probably seen more rent go towards resource. So I think it's really hard for miners today to invest in downstream.
So Mark made the same claim that a South African study concluded that mining is where most benefits gets generated for the country. And clearly that's true for the mining companies. That's why they do that. But the politicians think differently. They think there is a space that the value is being added in China, not in South Africa, or not in...
Well, I think it comes down to the factors of production. And the reason that we can't compete in South Africa is, firstly, we don't have an energy supply consistency, and it's becoming increasingly more expensive. Secondly, probably our labor productivity isn't where it should be. I mean, I think we've made some good strides, but it's not where it needs to be. And I think thirdly, the cost of capital equation is completely different. You have to put your own money to work, whereas often you get state money at pretty subsidized rates. So if you put all of those things together with a long-term strategy of really making this work, it's incredibly difficult for us to compete with China on that basis. So whilst it's a very noble goal, I think the better opportunity for us is to maximize the rent on the resource that we've got available to us. And if we can continue to drive that, there will be incremental opportunities to improve downstream, but that shouldn't be the focus, in my view.
When we chatted a week or so ago, I was very interested in some of your take on sort of cost of capital and capital allocation. Where you sit now, you can allocate capital to South Deep in South Africa, to many jurisdictions in Africa and beyond. So help us with the thinking processes in Gold Fields when it comes to this.
Look, there's a couple of things I'll take a step on, and Neil probably going to shoot me for this one because you've been in gold longer than I have. But if you go back to prior to 2020, I think generally the gold industry has destroyed value. We haven't delivered above cost capital returns in the industry prior to 2020. Obviously, there may be exceptions, but Then post-2020, you started seeing a bit of a reset in gold price. So gold price has lifted, and now you're seeing companies generating a little bit of economic return on the investments. I think what you're starting to see now is generalists starting to get into the gold sector. Previously, investing in gold was largely the domain of specialist resource funds, etc., who kind of were happy to take the returns that were being offered. Now you're becoming, having to be really counted as a high-quality mining company. Gold just happens to be one of the things, the commodity that you're in. For us to continue to compete and be rewarded by shareholders for performance, you have to be seen to be really disciplined around how you allocate capital. And those that have both the combination of good capital discipline, good operating delivery performance, and probably a good jurisdictional risk profile, which I'm sure we'll get to in a minute, are the ones that ultimately get rewarded with higher relative ratings. And a great example in our industry, as in the gold industry, is you look at the largest company by market capitalization, or the most valuable, would be Agnico Eagle. This is a company that has 90% of its production probably out of Canada, tier one jurisdiction. It has probably a PNAV of about 1.3, 1.4 relative to the rest of us, about 1 times. They've got a price to cash flow of around 10 times versus our 6 times. So you can just see that gulf and the desire to find a high quality, low volatility gold stock, so you can get that leverage exposure to gold. So for us to try and compete with that we have to continue to be able to demonstrate that we are improving the quality of our returns, because that's the only way that you ultimately compete, is on that risk-based returns. And so for us to do that, we have to be really disciplined around how we invest the cash that's been generated out of our business. Again, gold is slightly different commodity than an industrial commodity. We're generally dealing with ore bodies that have a shorter relative life. We don't have 70 years of life in an iron ore mine or anything like that. So you're dealing generally with ore bodies that got 10 to 20 years of life at best. And when you make those investment decisions, you've got to be making those decisions in a way that you are ultimately improving the quality of your portfolio and the quality of returns over time. Otherwise, investors are going to say, just give us the money back. And that's the real tension in how we think about capital allocation, is that we're going to invest in our business. It's got to be a way that shifts the centroid return of our portfolio. Otherwise, we've got to give it back to shareholders.
So you were not in gold mining when the South African mining companies, of which Gold Fields at the time would have been one, told the story, or was told the story, that there's a South African discount. Do you think that was ever true, or was it more a capital return discount? I mean, there was a clear distinction between South African assets was valued like this, and non-South African assets were valued differently.
Yeah. Look, I think there's still a big education that needs to be made in the rest of the world. Now, I wouldn't call it a South African discount, and I think there's certainly a jurisdictional risk, and we can talk about that in broader terms in Africa. When you talk to investors, and I've just come off a week or so in North America, there's still a lot of questions being asked about the jurisdictional risk in Africa. Interestingly enough, another interesting example is the rating agencies. You know, when we've just gone out and raised a bond, and there were more conversations around, say, Ghana risk, because there's a new administration, than there has been around the fact that we've just done 2 acquisitions within 9 months of each other. So it's kind of interesting how the perception of risk is still there, and it's because sometimes investors don't understand the risk the way that we do. And so there's a real nervousness, is that you've now, in addition to overlaying operating risk in a portfolio, you're overlaying another jurisdictional risk. And that's why you're seeing these wide discounts between companies that don't have those exposures than those that do have it. But coming back to South Africa, I think that people are getting a lot more comfortable around the South African specific risk because we've been talking about BE, we've been talking about mining charter for like 20 years now. So I think those that have been close to South Africa are getting a better understanding of it. But I think there's definitely a concern about exposure to companies that have big exposures in South Africa. So I think fortunately for us in Gold Fields, our production out of South Africa is, say, 12% of our total portfolio interest. So whilst we believe we've got one of the best gold mines in the world in South Deep, at least it hasn't been discounted too significantly. And again, even in our portfolio build-up, to answer the question directly, I don't think we get fair value recognition for South Deep in our portfolio.
So you obviously think the decision to spawn off Sibanye was a good decision. Get rid of all your difficult gold mines to need.
Well, I mean, I wasn't around at that time.
I know, so you can be honest.
I can just say that I think for Nick Holland, who was around at the time, I think was reasonably inspired because, you know, I feel for Neil and Richard, I think those are really, really tough businesses. I mean, they, you know, highly people intensive. I think luckily South Deep is highly mechanized bulk mine, so the variability in operating that is much lower than I think the variability that you have to deal with.
Yeah, we'll get his take on that. So there were a few false starts at Gold Fields in the growth strategy through acquisitions. You've done two in quick succession, successfully. I would say the difference is you've bought the other half of assets you already owned. You want to unpack your own sort of strategy because suddenly we think of Gold Fields as acquisitive, where it wasn't typically that.
Look, I think, and without making this quite clear, so I think the ambition around the proposed acquisition of Yamana at the time was actually reasonably sound. It was a potential ability to grow the business quite substantially in good jurisdictions. Ultimately, the problem is that the dilution that would have required was just unpalatable to our shareholders. It was never something that could fly. I think the way that we think about the business today is that we don't have to be the biggest by ounces produced, but what we do want to do is continue to improve the value of the company by growing our cash flow per share. And that means making incremental investments in a way that tomorrow is going to be better than the day that we've left. And if we can grow that margin on a relative basis better than our peers, then we will be rewarded for that. So we don't have to go out and make big acquisitions. As it turns out, I mean, both of these opportunities, as you rightly say, we already owned half of the businesses, and it was timing that presented the opportunity for us. And we're really excited about having got 100% of these two assets. But equally, we've got enough self-help in our portfolio that we could do our own things. But having said that, if you look at our portfolio today with Salares ramping up in Chile, we've got Windfall, which is going to come on in 2 years. We've got an amazing story ahead of us. So we don't have to go and do a huge amount of things. And in fact, the stuff that I'm hoping you'll see more of is those kind of incremental investors in the juniors. So we announced one last week where we took 10% of a junior invest in Ontario in Canada with some really great drill deposits. Drill results, and we've got some really interesting drill holes going into New South Wales in Australia. We've got some really interesting stuff in Chile. So that, to me, we want to fill the pipeline in 2030 to 2040. We don't have to do stuff today. So that's kind of probably where we're going to see more of this emerging.
So ex-colleague of mine, Marianne, she's actually, she sent me a WhatsApp a few weeks ago, with the gold price having gone through 2 million rand a kilogram. No, I'm not going to translate that into pounds, but that's a shitload of money per little bit of gold. And of course she did it because she remembers, like I do, when gold was at 35,000 rand a kilogram. This is a phenomenal gold price. Is this sustainable? Is this what the world wants to pay for gold now? Can you build a corporate strategy on this high gold price environment?
Well, I think there's two things. I mean, two questions in that. I think first and foremost is I do believe that gold is got more upside to it, and I think that's probably not out of line with what some of the consensus views are. And I think there's a couple of things supporting that. I mean, clearly we're becoming an increasingly VUCA world around us, and I think people are increasingly seeing gold as a place to create some safe haven status as, particularly as there's a de-dollarization that's taking place. And there's a number of drivers of gold demand. I think one of the other interesting statistics that I saw the other day is that historically gold in portfolios have been around 5% of portfolios. Today, it's probably the lowest it's ever been in the last 50 years. It's probably around 1.5% of portfolios. So even if portfolios get back to kind of long-term averages, you've got a significant amount of headroom. And that's without central bank buying and all the other the drivers of demand. So I do believe that gold has got more way to run. I think the second part of your question, though, is actually quite a vexed one for us, because as miners, you probably know that there's been periods of deep despair when gold prices have been very low. So you don't want to plan for a world of higher gold prices. So like most of us, you'll have a reserve price around $1,500. We're probably in a world now we've got the greatest disconnect between reserve prices and what the actual gold prices are. And then you say, well, how much value are we leaving behind by having this huge, big disconnect? So this is one of the key conversations that we're having, is to say, well, what is the appropriate way that we need to plan for the resources that we have got exposed to? Because if you make the wrong decisions, you then go out and buy other stuff and allocate money to buying other stuff rather than maximizing the economic return of the resource that you have within your portfolio. So I think from our point of view, you're probably going to have to be really quite nuanced in saying, okay, maybe we need to be lifting reserve prices in order to maximize the resource recovery of what we have, but trying to do it in a way that you don't allow costs to run away. So it's got to be, you've got to find a way of saying, okay, I've got a reserve price, I might be able to lift that, but you then have got to make sure you don't allow costs to go up and match that, because that's where you're going to start creating more portfolio risk. So it's a very interesting kind of conversation. I'm sure many of our peers are having the same discussion.
And we'll explore it with the other gold miners, but I was still in the industry when we invented this 3-year trailing gold price to justify having a reserve price higher than the spot price. So that's where it comes from now. Now you're caught by our cleverness of 20 years ago, because now it's rising and 3-year trailing gives you 1,500. Good luck with that. So I want to unpack a little bit back to, so we spoke about capital allocation, but this is a conference about mining in Africa. You sit and you can allocate money in different African jurisdictions or outside Africa. So perhaps if you were to speak generically to government officials in Africa, what are the things that a country should consider to make it easier for Gold Fields to invest in their country? Generically, I'm not. Look, I don't want you to bash a country.
I think for all of us, it's just stability and certainty, because again, we've got exposure into 2 countries, really big investments in South Africa and in Ghana, and right now both of those countries are kind of tweaking with policy, and again, if I think about the roadshows that we've just come off, that kind of takes a disproportionate amount of time. Yeah. In the engagements and the conversations. And so it's not about, well, it's about how we share value, but it's just about creating certainty. And the quicker we can get the noise out of the system, and I can see CMZ, and I said to him this morning, I said, he's now got a big job ahead of him in just dealing with some of the new MPRDA discussions that are going on. But that stuff doesn't help us as an industry. And ultimately, I know we'll find each other and we'll create certainty. But every time you find another conversation emerging, it just creates noise, it creates uncertainty, and then those that are uninitiated would say, well, this is Africa being Africa again. You can't settle on the rules of the game.
So, I mean, there have been some rumors that I pursued South Deep and trying to acquire it. I don't want to comment on that, but flip that ore body. Is finally delivering. It's
amazing.
Is it delivering
now?
It's
absolutely amazing. Look, I think for South Deep, and it's always about the mining cycle. So the quicker you can turn around stopes and you can advance mining there, the quicker you can ramp up production. I mean, that's gotten, and I know 20-odd years ago, they were talking that about a 600,000 ounce mine. I mean, now we do 300 to 350. There's a lot of installed potential in there. The other thing that you're seeing is this rapid deployment of technology, which when you've got a 70-year life ore body, you can absolutely believe that in the next decade or two, you're going to have a transformed way of mining at 3 kilometers underground. And I think you will then find ways of really changing the constraint. And that's really the key driver for us at South Deep, is if you can change that mining cycle and you can improve the turnaround time, you're going to find a huge unlock of potential there. And that's why we love the asset. I think it's just one of those really unique ore bodies in the world. And I think we are very fortunate to have it in our portfolio.
And so I've had fun with your predecessors about the 600,000 ounces. That was always just another 3 years out.
You'll hear I never talk about 600,000
I know.
ounces,
You reminded us that what. So just give us a sense. So what is South Deep now? Is it a 350,000? And what is the sustainable all-in cost, just to calibrate it for the audience?
So I think the one thing that's interesting about South Deep is, it's a highly fixed cost mine, so kind of 85% of the costs are fixed. So every time you can incrementally improve ounces, you kind of dilute costs. I think our medium-term horizon on South Deep is probably, certainly this decade, is getting it up to 12 tons or kind of 360,000 ounces, which is about 20% up from where we're gonna finish this year. And that will be very dilutive on cost. So you should find your way down to around $1,500, $1,400 an ounce, and then that's a highly valuable mine. As we think about the next investment horizon into the 2030s to south of Wrench, it gives us the opportunity of potentially lifting up again, probably to the 15 tons, but that's the second horizon which we're still studying at the moment. Yeah.
There's a specific question about, sorry, I've worked the questions into the conversation, but there's a specific question. You mentioned stability and certainty. To what extent does Gold Fields consider investment treaties to improve its position in relation to political risk? That used to be a thing in Ghana. I don't know anymore. You could never have a special treaty in South Africa that I'm aware of.
No, but in Ghana we do have, certainly we have stability agreements. But again, there's and this is something for us as Africans, we need to look at ourselves in the mirror as well, because equally it's quite offensive sometimes to African countries to say, well, why, if we have a disagreement, should we come to London and kind of get someone to solve our problem for us? And I think maybe there's something that we have to do with the Africa Union or whatever to actually have a better way of engaging on this stuff. But certainly, whilst treaties have a role to play, and I mean, it's not just Africa that uses them, and we've seen success in other parts of the world, it's much better to find a way of resolving these things without relying on international treaties. But
yeah, I want to close off. I really am so interested in the whole Goldfield story. I could spend another hour. But the one thing, so you say suddenly you're drawing other investors beyond the traditional gold investors. But what happened to my 3G investors, those who believe in God, guns, and gold? Are they still around?
Well, I think the issue is that many of those are of buying physical gold, and I think you are seeing that emergence of physical gold. And what's interesting about some of those folks that are buying physical gold is that often that just gets locked away and kind of never comes back into circulation. So that definitely is.
It's still on the physical side also. Yeah, you're not leveraged enough. I mean, I represented a leveraged company, so there was a story to tell.
Yeah.
Ladies, gentlemen, please join me in thanking Mr. Goldfields.
Thank you very much, Bernard.
So good to have you with us, Mike. Thank you very much. Thank you.